When you think of the Iraqi dinar, you can't separate it from one thing: oil. Oil isn't just Iraq's lifeline. It's the very heartbeat of the currency itself. And when we add U.S. policy into the equation, the connection becomes even more powerful and sometimes more dangerous than many realize. Tonight, we pull back the curtain to reveal the hidden connection between oil prices, American policy decisions, and the fate of the Iraqi dinar. Let's start with the obvious. Iraq sits on one of the largest proven oil reserves in the world. Every single day, millions of barrels leave Basra's ports, feeding the global economy. That oil is sold in dollars, always in dollars, which means before a single dinar is printed or spent, Iraq's financial health is already tied directly to the strength of the US dollar and the price of oil on world markets. If oil prices soar, Iraq's revenues surge, and the dinar gains breathing room. If oil prices crash, revenues collapse, and pressure mounts on the currency. This simple equation drives nearly every fluctuation in Iraq's economy. But the story doesn't stop there, because oil prices are not just about supply and demand. They are deeply influenced by U.S. policy. Think about sanctions on countries like Iran, Venezuela, or Russia. Every time Washington restricts one major producer, oil markets shift, and Iraq either benefits or suffers. Higher global prices may bring in more revenue, but they also raise the cost of imports, squeezing local families. Lower prices, on the other hand, cut into Iraq's budget, making it harder to pay salaries, fund reconstruction, or stabilize the dinar. And then there's the Federal Reserve. When the Fed raises interest rates, the dollar strengthens globally. Oil, priced in dollars, becomes more expensive for other countries, and often oil demand cools. For Iraq, that means lower revenues and more pressure on the dinar. When the Fed loosens policy, the opposite happens. Weaker dollar, stronger oil demand, and more space for Iraq's economy to breathe. In other words, decisions made in Washington boardrooms ripple directly into Baghdad's exchange markets. But let's go deeper, because this isn't just economics, it's geopolitics. The United States has long had a hand in shaping Iraq's currency policy. From the sanctions era in the 1990s to the post-2003 reconstruction, to today's strict compliance rules on dollar transfers, Washington's influence over Iraq's financial system has never disappeared. And because oil revenues are collected in dollars, Iraq is always negotiating the delicate balance between its own sovereignty and the leverage of U.S. financial institutions. Now, here's where the hidden connection really comes to life. Imagine oil prices rise sharply, giving Iraq more reserves than it's had in years. On paper, the dinar should strengthen. But if the U.S. Treasury and Federal Reserve simultaneously tighten restrictions on dollar flows into Iraq, limiting access, tightening monitoring of banks, enforcing sanctions compliance, the effect can actually choke liquidity, keeping the dinar weak on the street despite higher oil revenues. This is why dinar holders often scratch their heads. Why isn't the currency stronger if oil money is pouring in? The answer lies in the invisible strings of U.S. policy. On the flip side, consider when oil prices fall. Iraq faces budget shortfalls, public unrest, and the risk of a widening gap between the official rate and the black market rate. In those moments, Washington's stance matters more than ever. If U.S. policy gives Iraq room, relaxing restrictions, providing support through international institutions, or backing dollar auctions, the dinar may hold steady. But if the U.S. doubles down with more oversight or political pressure, the strain multiplies. This tug-of-war creates both risks and opportunities for dinar holders. The risk is clear. Your currency is not just hostage to Iraq's oil exports, but to policy decisions made thousands of miles away. A White House announcement, a Treasury sanction, or a Federal Reserve rate change can shift the value of your holdings without warning. The opportunity, though, lies in foresight. If you understand the connection, if you track oil prices and U.S. signals, you can predict the pressure points before they hit the market. Let's talk numbers for a moment. Iraq's budget depends on oil for over 90% of its revenues. Every $1 shift in global oil prices changes Iraq's annual income by nearly $1 billion. That's how sensitive the system is. Meanwhile, U.S. policy decisions on interest rates or sanctions can shift the dollar's global strength by 5 to 10% in a matter of months. Put those together, and you realize the dinar's value is not just a local issue. It's plugged into one of the most powerful economic engines on the planet. And here's the irony. Iraq has tried to shield itself. It has explored using the euro, the yuan, and even direct barter for oil. But in the end, the global system keeps pulling it back to the dollar. Because as long as oil is priced in dollars, and as long as Iraq needs global credibility, the dinar's hidden connection to U.S. policy will remain unbreakable. Now, let's consider what this means for the future. Oil markets are changing. Renewable energy, electric cars, and climate policies are all threatening to reduce global oil demand in the long run. If demand falls and oil prices decline structurally, Iraq's lifeline weakens, and with it, the dinar's support. At the same time, U.S. policy is shifting, balancing Middle Eastern alliances, managing sanctions, and recalibrating its role in global oil security. For Iraq, this means the currency's future will not be decided in Baghdad alone, but in a complex dance between oil markets and Washington decisions. So what must dinar holders understand about this hidden connection? They must know that every barrel of oil sold is also a currency story. They must know that U.S. interest rate announcements are not just headlines for Wall Street. They are signals for the dinar's next move. They must know that oil shocks, wars, sanctions, and treaties all filter through one channel: the fragile exchange rate between the dollar and the dinar. For the family in Baghdad struggling with food prices, for the trader in Erbil buying dollars on the street, for the investor abroad holding stacks of dinar, this hidden connection is not just theory. It is lived reality. Oil prices rise, U.S. policy shifts, and the value of the dinar in your pocket changes overnight. And so, the next time you see oil futures climbing or the Federal Reserve announcing a new rate hike, don't dismiss it as distant news. Remember that those forces are the invisible hands shaping Iraq's currency. They are the hidden connection that explains why the dinar behaves the way it does. And for those who hold the dinar, understanding this connection could mean the difference between confusion and clarity, between loss and opportunity. The dinar's destiny is written not only in Iraq's oil fields, but also in the policies crafted in Washington. And as long as oil remains king and the dollar remains supreme, that connection will continue to define the future of Iraq's currency. We've already uncovered how oil prices and U.S. policy shape the Iraqi dinar. But the real question for viewers is this: what happens next? Where is the dinar headed, depending on how oil markets move and how Washington responds? Let's break down the future into 3 possible scenarios. Scenario 1. Oil prices crash below $50. Imagine global oil demand falls, maybe because of a worldwide recession, or because renewable energy adoption accelerates faster than expected. If oil prices drop below $50 per barrel, Iraq's revenues could fall by nearly half. That means the government struggles to pay salaries, imports become harder to afford, and pressure mounts on the dinar. In this scenario, Baghdad might be forced to devalue the dinar again, just like it did in late 2020, slashing its official value to keep the budget afloat. For ordinary Iraqis, this would mean higher food and fuel prices, and for dinar holders abroad, it would mean seeing the currency weaken further before it finds any stability. Scenario 2. Oil prices surge above $100. Now flip the picture. Suppose oil prices soar, maybe because of a supply shock in another region, sanctions on a major producer, or geopolitical tensions in the Middle East. At first glance, this looks like good news for Iraq. Revenues surge, the government suddenly has cash to pay salaries, fund reconstruction, and build reserves. On paper, the dinar should strengthen. But here's the catch. The stronger the oil market, the more Washington watches Iraq's dollar flows. If the U.S. Treasury believes dollars are leaking from Iraq into sanctioned countries like Iran or Syria, it could tighten restrictions. That means even with high revenues, Iraq may struggle to get those dollars into its local economy. And the dinar could remain under pressure, especially in street markets. Scenario 3. Iraq shifts away from the dollar. This is the most ambitious but also the riskiest scenario. Iraq has already experimented with trading oil in currencies other than the dollar, like the Chinese yuan. If Baghdad pushes further in this direction, it could reduce its dependence on U.S. policy. That sounds attractive, but it comes with risks. Moving away from the dollar would complicate Iraq's ability to do business globally, because the dollar is still the world's dominant reserve currency. It could also trigger political friction with Washington, risking sanctions or reduced support. For the dinar, the outcome is uncertain. It could gain independence in the long run, but in the short term, volatility would likely increase. Now, let's bring this closer to home. What do these scenarios mean for everyday life in Iraq? For families in Baghdad or Erbil, the connection between oil and the dinar shows up most clearly in food and fuel prices. Bread, rice, cooking oil, all imported, all tied to the dollar. A weaker dinar means these essentials cost more, stretching household budgets thin. Fuel, too, is affected even in an oil-rich nation. When the dinar weakens, the cost of imported refined fuel and spare parts rises, and that cost trickles down into transportation and electricity bills. In other words, the strength of the dinar decides how comfortable or how difficult daily life feels. For business owners, the dinar's swings mean uncertainty. Imagine trying to plan a shipment of goods when the exchange rate could shift dramatically in a matter of weeks. This uncertainty pushes many traders toward the black market, where dollar prices fluctuate wildly, further destabilizing the official exchange system. And for dinar holders abroad, this hidden connection is crucial. If you're holding on to Iraqi currency as an investment, you need to realize that its future is not just tied to Iraq's internal decisions, but to oil prices and U.S. policy. A sudden shift in either can dramatically alter the value of your holdings. But there's one more layer: politics. Every time Baghdad and Washington disagree, the dinar feels the shock. Every time OPEC Plus makes a decision on oil output, the dinar shifts again. This is why understanding the hidden connection is so important. It's not just about economics. It's about power, influence, and the tug-of-war between global giants and local realities. So where does this leave us? The dinar's fate lies at the crossroads of oil and policy. If oil prices remain strong and U.S. policy remains cooperative, Iraq could stabilize its economy, strengthen the dinar, and improve daily life. But if oil weakens or Washington tightens its grip, the pressure will return, and the currency will continue to struggle. For Iraqis, this means keeping one eye on the global oil market and the other on Washington's decisions. For dinar holders, it means recognizing that the currency's value is not random. It's the product of forces far bigger than a single country's economy. And that is the hidden connection. Oil, U.S. policy, and the dinar, three forces bound together, shaping the future of Iraq's economy and the future of everyone who depends on this fragile currency.